Welcome to Economy Revelations. This channel is built for those who have lived long enough to see cycles repeat, who remember when money felt different, more real, more disciplined. If you believe experience matters more than noise, and patience more than prediction, consider subscribing. Not urgently, just thoughtfully, the way one old friend quietly suggests something important to another. And before continuing, share where you are watching from, because economics may be global, but its impact is always personal. For most people, markets appear healthy when prices are rising. Green numbers create comfort. Indexes moving upward suggest stability. But markets do not run on prices. They run on liquidity. Liquidity is not wealth. It is not money printed on paper. It is the ability to transact without friction, to buy without hesitation, to sell without collapse. For more than a decade, global markets lived inside an artificial environment. Liquidity was abundant, predictable, and constant. Central banks injected capital regularly. Rates stayed low. Risk was absorbed, delayed, or transferred. This created a dangerous illusion. Participants began to believe liquidity was permanent, that markets would always have buyers, that exits would always be available, but liquidity is not permanent. It is conditional, and those conditions have changed. A liquidity squeeze does not announce itself. There is no official statement, no emergency broadcast. Instead, it shows up in subtle ways. Bid-ask spreads widen slightly. Funding becomes selective. Collateral requirements quietly increase. Nothing dramatic, until suddenly everything is. The most dangerous phase of a liquidity squeeze is the early phase. That is when prices still rise. That is when confidence remains intact. That is when leverage quietly stays in place. Liquidity does not vanish overnight. It retreats. It pulls back from the edges first, from smaller markets, from weaker balance sheets, from assets that depend on constant refinancing. At the center, everything still looks fine. This is why most people miss it. Modern markets are built on continuous circulation. Capital flows through stocks, bonds, funds, and derivatives without pause. Risk models assume execution. Algorithms assume depth. Liquidity is not wealth. It is not money printed on paper. It is the ability to transact without friction, to buy without hesitation, to sell without collapse. For more than a decade, global markets lived inside an artificial environment. Liquidity was abundant, predictable, and constant. Central banks injected capital regularly. Rates stayed low. Risk was absorbed, delayed, or transferred. This created a dangerous illusion. Participants began to believe liquidity was permanent, that markets would always have buyers, that exits would always be available, but liquidity is not permanent. It is conditional, and those conditions have changed. A liquidity squeeze does not announce itself. There is no official statement, no emergency broadcast. Instead, it shows up in subtle ways. Bid-ask spreads widen slightly. Funding becomes selective. Collateral requirements quietly increase, nothing dramatic, until suddenly everything is. The most dangerous phase of a liquidity squeeze is the early phase. That is when prices still rise. That is when confidence remains intact. That is when leverage quietly stays in place. Liquidity does not vanish overnight, it retreats. It pulls back from the edges first, from smaller markets, from weaker balance sheets, from assets that depend on constant refinancing. At the center, everything still looks fine. This is why most people miss it. Modern markets are built on continuous circulation. Capital flows through stocks, bonds, funds, and derivatives without pause. Risk models assume execution. Algorithms assume depth. But assumptions are not guarantees. When liquidity tightens, behavior changes before prices do. Institutions stop chasing returns. They begin protecting balance sheets. Cash becomes more valuable than opportunity. This is the turning point. The shift from expansion to contraction is not emotional. It is mechanical. Higher funding costs change incentives. Refinancing becomes difficult. Leverage becomes dangerous. At this stage, markets can still rise, but they rise without strength. Volume thins. Moves become fragile. Optimism remains. Structure weakens. This is when headlines stay calm, but foundations begin to crack. Liquidity crises are not caused by panic. They are caused by absence, the absence of buyers, the absence of risk tolerance, the absence of capital willing to absorb shocks. And once that absence becomes visible, prices do not adjust politely. They gap. Markets do not crash because people sell. They crash because no one can buy. By the time volatility appears, liquidity has already been withdrawing for months. This pattern has repeated throughout history. Abundance, complacency, silent tightening, rupture. What makes the present moment different is scale. Markets are larger, more interconnected, more dependent on automation. Liquidity is no longer just helpful. It is assumed. And when assumptions fail, systems behave in ways few expect. Price is the outcome. Liquidity is the cause. And once liquidity becomes constrained, everything else follows. What comes next is not speculation, but mechanics. because the system has already begun operating under new rules. Liquidity crises are often misunderstood because they do not begin where people are looking. They do not start on stock charts. They do not begin with panic. They begin inside balance sheets, funding markets, and risk controls, places most investors never see. From the outside, markets appear active, trades execute, prices move, news cycles continue. But internally, behavior changes. The first shift always occurs among institutions, not retail participants. Banks, funds, insurers, and large asset managers do not react to headlines. They react to constraints. Liquidity, at its core, is permission. Permission to deploy capital. Permission to take risk. Permission to hold positions without fear of being trapped. When that permission is questioned, activity slows, even if prices have not yet responded. The modern financial system is built on layers of leverage. Assets are pledged as collateral. That collateral supports borrowing. That borrowing funds additional assets. This chain works only as long as confidence in collateral remains intact. A liquidity squeeze begins when lenders reassess that confidence. Higher interest rates are not just a cost issue. They are a filter. They force capital to become selective. When rates rise, lenders demand better collateral. Haircuts increase, margins widen, nothing breaks immediately. But pressure builds. At the same time, refinancing risk increases. Debt that once rolled effortlessly must now be justified. Borrowers face scrutiny instead of accommodation. This is where liquidity quietly contracts. Institutions begin prioritizing survival over returns. Cash is no longer idle, it is strategic. Holding liquidity becomes a competitive advantage. As this behavior spreads, funding markets tighten. Short-term lending becomes cautious. Overnight markets grow sensitive. Counterparty risk becomes a topic again. These are early signals, but they rarely make headlines. The system's vulnerability lies in its dependence on continuous funding. Many large entities operate with maturity mismatches. They hold long-term assets funded by short-term liabilities. As long as liquidity flows, this is manageable. When it slows, risk accelerates. A critical element in modern markets is algorithmic execution. Automated systems assume liquidity will always be present. They assume depth at every price level. But algorithms cannot create liquidity. They can only respond to it. When liquidity thins, algorithms amplify movement instead of stabilizing it. Small dislocations turn into sharp moves. Price gaps appear. Volatility increases, not because of fear, but because of absence. At this stage, human discretion re-enters the system. Risk managers intervene. Position limits are reduced. Exposure is cut preemptively. This behavior is rational, but when executed simultaneously across institutions, it becomes systemic. The most misunderstood aspect of liquidity squeezes is that selling is often not the trigger. Withdrawal is. Institutions stop reinvesting proceeds. They allow positions to mature without replacement. They reduce exposure quietly. Markets still trade, but on thinner foundations. Another critical mechanism is collateral repricing. When asset prices decline slightly, collateral values fall. That triggers margin calls. Margin calls force asset sales. Those sales further depress prices. This is not panic, it is arithmetic. The system does not need fear to break. It needs constraints to tighten. Liquidity squeezes also propagate unevenly. Strong balance sheets endure longer. Weak ones fail early. This creates a false sense of security. Observers see stability at the top and assume the system is healthy. But stress is already spreading underneath. By the time visible cracks appear, contagion is advanced. One of the most dangerous features of modern markets is synchronization. Global institutions operate under similar rules. They use similar models. They respond to similar signals. When conditions change, reactions align. This is why liquidity events move faster today than in the past. There is less diversity in behavior, less patience, less tolerance for uncertainty. Liquidity becomes binary, available or unavailable. Once it flips, recovery is not immediate. Even central intervention does not instantly restore confidence. Trust, once questioned, takes time to rebuild. Markets can stabilize temporarily, but damaged liquidity leaves scars. Participants remember being trapped. They adjust future behavior. This is why liquidity crises reshape markets long after prices recover. Understanding this mechanism is essential, because by the time equity investors notice falling prices, the real process is already complete. Liquidity has already retreated. Capital is already repositioned. Risk has already been repriced. The market is simply catching up. In the next part, attention will shift to consequences, why equities are uniquely vulnerable during liquidity squeezes, and why certain assets do not merely survive these periods, but detach from the system entirely. Because liquidity contraction does not impact all assets equally. It reveals what is financial and what is fundamental. Liquidity contraction does not treat all assets the same. It exposes the difference between what is financial and what is fundamental. When liquidity is abundant, that difference is hidden. Stocks, bonds, commodities, and derivatives rise together. correlation feels normal. Diversification appears to work. But when liquidity tightens, correlation collapses into hierarchy. At the top of that hierarchy sit assets that require constant buyers. Public equities are among them. Stocks are not owned outright by most participants. They are held through funds, indices, leverage, and synthetic exposure. Their prices depend not only on earnings, but on continuous capital inflows. When liquidity contracts, those inflows weaken. Index funds experience outflows. Margin requirements increase. Leverage becomes expensive. None of this requires fear. Selling begins not because investors panic, but because structures demand adjustment. Positions are reduced to meet risk limits. Cash is raised to satisfy obligations. This is where equity markets become fragile. Stocks rely on depth. They require buyers at every level. When liquidity thins, depth disappears. Large orders move prices disproportionately. Volatility increases without news. This is why equity declines. During liquidity squeezes often feel sudden. The system is not reacting emotionally. It is functioning mechanically. Another critical factor is valuation sensitivity. Equities are discounted cash flow instruments. Their value depends on assumptions about growth, stability, and future funding conditions. When liquidity tightens, discount rates rise. Future earnings are worth less today. This repricing does not happen gradually. It accelerates as assumptions change simultaneously. As stocks reprice downward, confidence erodes. That erosion feeds back into liquidity. More selling pressure emerges. Less capital steps in. The process becomes self-reinforcing. Now contrast this with silver. Silver occupies an unusual position in the financial system. It is both a monetary asset and an industrial input. It exists inside markets, but not entirely of them. Most importantly, silver does not depend on continuous buyers in the same way stocks do. Physical silver cannot be created digitally. It cannot be leveraged infinitely without consequences. Its supply responds slowly to price. During periods of abundant liquidity, silver often underperforms. Capital prefers yield, growth, and leverage. Precious metals appear unnecessary. But when liquidity tightens, incentives reverse. Capital stops chasing returns. It begins seeking preservation. This shift changes behavior. Investors reduce exposure to assets that depend on leverage and funding. They increase interest in assets that exist outside the credit system. Silver benefits from this shift not because of speculation, but because of structure. Unlike equities, silver does not represent a claim on future cash flows. It represents a tangible store of value. As trust in financial assets weakens, interest in monetary metals rises. At the same time, silver faces a supply constraint. Mining output cannot respond quickly. Existing inventories are limited. Industrial demand does not disappear simply because liquidity tightens. This creates pressure. But the most important factor is market structure. Silver trades in two worlds, paper and physical. Paper silver is highly leveraged. Physical silver is not. During normal conditions, paper markets dominate price discovery. But during liquidity stress, that dominance weakens. When trust in paper claims declines, physical demand increases. This creates a disconnect. Paper prices may lag. Physical premiums rise. Eventually, price discovery shifts. This is what observers often misunderstand. Silver does not move because of enthusiasm. It moves because constraints tighten. When liquidity leaves the system, financial assets compete for fewer buyers. Prices fall. At the same time, monetary assets face increasing demand from capital seeking safety. Prices rise. This divergence is not emotional. It is rational. Equities represent participation in a system that depends on liquidity. Silver represents protection from that dependency. During liquidity squeezes, this distinction becomes visible. History supports this pattern. In every major liquidity event, assets tied to leverage suffered first, assets tied to monetary function strengthened later. The timing is important. Silver often moves last, not first. It reacts after confidence erodes, not before. This leads many to dismiss it until repricing accelerates. When silver finally moves, it does not adjust gently, it gaps. Because supply cannot meet demand quickly, because paper markets lose control, because trust shifts abruptly. This is why extreme price targets are often misunderstood. They are not forecasts. They are reflections of imbalance. When demand surges into a constrained market, price does not negotiate. It jumps. Stocks, in contrast, negotiate continuously downward during liquidity stress. They search for buyers. Silver searches for supply. That difference defines the outcome. Understanding this divergence is essential for decision makers, not to speculate, but to recognize where liquidity risk concentrates. Because liquidity contraction does not destroy all value. It redistributes it. In the next part, the focus will turn to strategy. How businesses, investors, and decision makers should think during liquidity squeezes, not in terms of prediction, but in terms of resilience, positioning, and optionality. Because surviving liquidity stress is not about timing markets. It is about understanding which assets depend on the system and which exist beyond it. When liquidity contracts, the rules that governed the previous cycle no longer apply. Strategies that worked during expansion become liabilities during restriction. The greatest risk is not market decline. It is operating with assumptions that are no longer valid. Decision makers often fail, not because they lack intelligence, but because they react too late. They wait for confirmation. They look for official signals. They rely on models built for stable environments. Liquidity stress punishes delay. In constrained systems, speed matters less than preparation. The objective shifts from maximizing returns to preserving optionality. Optionality is the ability to act when others cannot. This begins with understanding exposure, not just to assets, but to liquidity itself. Many businesses believe they are insulated from market stress because they do not trade financial instruments. This belief is often incorrect. Liquidity affects credit availability. It affects refinancing terms. It affects customer demand and supplier stability. A business dependent on continuous funding is exposed even if revenues appear strong. The first strategic adjustment during liquidity contraction is reassessing leverage. Leverage amplifies outcomes in both directions. In expansion, it accelerates growth. In contraction, it accelerates failure. Reducing leverage is not an admission of weakness. It is an acknowledgement of changed conditions. Strong operators understand that capital structure determines survivability. The second adjustment involves cash management. Cash is often misunderstood as idle. In liquidity-constrained environments, cash is strategic. It provides flexibility. It absorbs shocks. It allows acquisition of distressed opportunities later. Holding liquidity when others are forced to sell creates asymmetric advantage. This does not mean hoarding indefinitely. It means respecting timing. Liquidity cycles do not reward early aggression. They reward patience. Another critical element is duration risk. Long-duration assets are vulnerable during liquidity squeezes. They depend on stable funding and predictable conditions. Shortening duration, financial and operational, reduces exposure. This applies to investments, contracts, and commitments. Flexibility becomes more valuable than optimization. Decision makers must also reassess diversification. Traditional diversification assumes correlation stability. Liquidity events break that assumption. Assets that appeared uncorrelated may move together under stress. True diversification during liquidity contraction is structural, not statistical. It involves assets, revenue streams, and exposures that do not rely on the same funding mechanisms. This is why understanding system dependency matters. Another strategic mistake is relying on timing precision. Liquidity events do not follow schedules. They accelerate unpredictably. Waiting for perfect entry points often results in missed exits. Strategic positioning is not about predicting exact outcomes. It is about ensuring resilience across plausible scenarios. This requires scenario thinking rather than forecasts. What happens if funding tightens further? What happens if refinancing costs double? What happens if counterparties fail? Asking these questions early allows adjustment without panic. Leadership behavior also matters. During liquidity stress, transparency builds trust. Employees, partners, and investors respond better to clarity than reassurance. Pretending conditions are unchanged delays necessary adaptation. Strong leadership acknowledges uncertainty without dramatizing it. Another overlooked aspect is psychological discipline. Liquidity contraction creates noise. Volatility increases. Narratives compete. Decision makers must resist reactive behavior. Selling purely out of fear destroys value. Ignoring risk destroys survival. The balance lies in deliberate action. Those who succeed during liquidity stress tend to share characteristics. They reduce exposure early. They preserve capital. They avoid forced decisions. They wait for clarity. They understand that opportunity emerges after dislocation, not before. Liquidity crises are not permanent. They redistribute power. They expose fragility. They reward preparedness. Once liquidity stabilizes, the environment changes again, but participants who survived intact now operate from strength. They have capital when others do not. They have credibility when others have excuses. They have choices. This is the deeper lesson. Liquidity squeezes are not merely market events. They are filters. They separate growth built on structure from growth built on assumptions. They reveal which strategies depend on continuous expansion and which endure contraction. For decision makers, the objective is not to predict collapse. It is to remain operational, flexible, and solvent regardless of outcome. Because when liquidity finally returns, and it always does, it flows first to those who are already standing. Not those who hoped, not those who waited, but those who prepared. And that is the difference between reacting to history and positioning ahead of it.